Traders, in this module we're going to look at risk and how we would apply risk to our trading. We're going to cover the definition of risk, a trader's view of risk, the risks that we're taking in our trading, how professionals and amateurs regard and look at risk. We're then going to look at the market and psychological exposure that we put ourselves under when we trade, which will also affect in the risk that we take. We're going to look at some components of a trading system. We're going to look at terms such as probabilities, leverage and margin. Then briefly cover ESMA, who they are and why they have an impact on the risk that we take. And then we'll subsequently bring it all together with an example. So, what is risk? Well, dictionary definitions. Risk is a situation involving exposure to danger. Another definition is the possibility of loss or injury. And lastly, we have an exposure to the chance of loss or damage. So asking the question, can risk be avoided? Well, yes it can. You can avoid risk by avoiding your exposure to the risk. In reality, it's impossible to achieve risk avoidance as a trader. When we have money in the market, it is always at risk. So it doesn't matter which way the money is going in terms of your trade, your money is at risk while it is in the market. Now, just to take the view of a stock trader and hedge fund trader, George Soros, a very well-known trader through certainly the last 30 years. You can Google him and you can find out more about his career and trading exploits. He's made billions and lost billions, but overall he's still alive and kicking and obviously still making money. His philosophy in terms of trading and risk is, the secret is to embrace the risk and not to try and avoid it. And basically what he's saying here is if you try to avoid risk in your trading, you are not going to succeed as a trader. And his first principle is survival and making money afterwards. We'll look at that in more detail later on in the module, but basically what he's saying is he assesses what he can risk by putting his money into the market. Even if he loses, he still survives to trade another day. Now then, trading is a potentially high risk business. All boils down to how you manage your money in your trading. Risk management. We manage trades so that we have levels of acceptable loss when they occur. There is no way to avoid losses in trading. Well, there is actually. You don't trade. But if you're a trader and you're putting money into the market, you will take losses. It's inevitable. The best trading systems in the world are not 100% perfect, but it's all about managing the risk that the money that you have in the market. Fund management. This is the money you actually have deposited with your broker. The trader's imperative. You need to know the risk, how much you're risking before you enter the market. So let's have a look at professional versus amateurs. Professionals are always focusing on protecting capital and limiting risk. Recall back to George Soros. He said the secret behind his success is to embrace risk, not to avoid it, but his first principle is survival. Focus is almost entirely on gains with amateurs. They tend to give scant regard to stops and scant regard to how much money they're actually risking in terms of the overall money they may have in their fund. So we want to trade like professionals. We're focusing on protecting capital and limiting risk. So, from professional versus amateur, who wins the long game? Who's in it for the longer term? Well, the pros will always take money away from the amateurs. Now, I've already said that even a professional trader makes gains and also takes losses. Professionals who are making gains are not only taking money away from amateurs, but they're taking money away from professionals on the other side of their trade. But overall, the professional has sound money management, manages their risk appropriately so that when they take losses, they are surviving and able to trade another day. An amateur, on the other hand, will take losses, often large losses relative to the size of their trading account, and eventually they will lose their fund entirely. So how much risk should we place on a position? It really does depend, and it can become quite complex. There are factors such as market exposure, how many trades to build a position in the market. Normally as day traders we are taking single trades at any one time. However, swing traders, on the other hand, may actually go into the market 1, 2, 3 or 4 times and actually build a position on their trade setup. Psychological exposure. If you have more than one trade in the market at any one time, that will then build up on your psychological exposure to the market. And in that, what I mean is the more money you have at risk in the market, the more prone you may become to not managing your trades correctly. If you have 2 or 3 trades going against you and you are putting on another position that is a valid setup, you may hesitate to take that trade. You may have 3 trades running in the market, 2 of them are going against you, and you'll cut the losses before it gets to your planned stop. All of these psychological effects can affect the way that you trade a system or trade several systems. The system metrics. What is the probability of a gain or loss within your system? There's a term called system expectancy, which is outside the scope of this particular module, but basically a system will have been back tested and forward tested live before putting real money on that system into the market. Now the system metrics will tell you what the probability is of a gain in your trade and what the probability of a loss in your trade is. You also calculate how much the gain is relative to the expected loss, and from that, using all those metrics, you can calculate your system expectancy. If you haven't got a positive system expectancy for your system, it will lose money. System frequency. How often does an event actually trade? You may have trades that only trade maybe once a month, or perhaps once a week, or maybe it's triggered by a particular news event or scheduled market news release. All of these things affect the frequency of your system and how often it trades. Now, depending on how often it trades may actually have a bearing, along with the system expectancy, of how much you might be prepared to risk on that particular trade. System latency. Well, the latency of your trading system is how long on average does a trade live in the market. You may have trades that only last on average half an hour to say 3 hours. You may have trades that last from 3 or 4 hours to maybe go through overnight into the next day. If you've got trades running while the market is closed, again, that will have some impact on your psychological exposure to the market, as well how much you can actually put on in terms of trades. And again, that comes back to tying in with system frequency. And a good place to start, assuming you're only taking 1 trade per position, is to risk 1 to 2% of your trading fund. So what does that 1 or 2% look like? We'll say we have a nominal £10,000 trading fund. Now, as you stress here, that doesn't mean to say you have to have £10,000 in your trading account, but what it does mean is you need to have enough money to risk to trade a £10,000 fund. If you were risking 1% per trade, you'd be risking effectively £100 on every trade. Now, what we need to understand is that day trading, whether we're using spread bet or CFDs, is a leveraged form of trading. And by leveraged, it means we can trade a small amount by putting a small amount into the market, we can leverage it up. More on this in a minute. In reality, risk in terms of money management is about probabilities and margin. And by that, it then takes me back to what I've just mentioned to do with trading risk and the frequency of trading, how the system metrics work, what's the risk-reward ratio, what is the percentage risk against percentage gain, and how often does it win and how often does it lose, and the amount you win and the amount you lose. So as I've said, leverage is a facility to exposure within the market that we're trading. And probability is about the percentage success rate of the trading system. And we need margin in our account because that is the funds required in order to place a trade. Every broker has margins set depending on what markets and type of trade you're taking. It varies from broker to broker. So probabilities. Let's take an example that we have a trading system that has a probability for success of 75%. Now that may sound rather high, but there are systems out there. I trade 2 or 3 systems that have a success rate of 75%. However, the gain to loss ratio is less than 1, and by that I mean a gain within the trading system is less than a loss within the trading system. Now, you may think that that might lose money overall, but because the system has a 75% success rate, this means that the system itself is profitable overall. Gains may be less than the losses, but there are more gains than losses, therefore the gains far outweigh the loss. Now, statistically, the probability of 5 consecutive losses in 50 trades is 4.4%. Now, I'm not going to go into the mathematics for that. You can look up on a search engine. You will find a whole wealth of information that shows you how this can be calculated. It's purely mathematical probability statistics. Now, that's very small, but the risk is still there. It's still possible. So I'm going to take this as a measure for calculating what margin I would realistically need to have available for my trading account. We need to have a system that requires funding over 5 losses. So next we're going to look at leverage and margin. So in order to look at leverage and margin, I'll just make a quick mention to ESMA, the European Securities and Markets Authority. They basically set the standard. Now, the proposal that's coming out this year is that there are going to be some changes in terms of leverage. Major currency pairs are going to be a 30-to-1 leverage, indices 20-to-1, commodities 10-to-1, and lastly a 5-to-1 leverage on equities. Now, those ratios can be converted into percentages, which are listed down the side of each respective leverage. So let's take an example. We'll use the FTSE 100 index and we'll just say that we're trading it at around 7,500 and we're using spread bet. Now, our system is telling us that the trade risk is 20 points for this particular trade, and we've already established that we're going to be risking 1% of our fund, which is nominally £10,000. Therefore 1% risk is £100, 20 points. That means we're going to be trading, assuming that the trade goes to a loss, would be £5 per point. 5 times 20, 100. Now, the buy level for the market is 7,500. We're going to go long at £5 a point, and a particular broker we're dealing with is now quoting us the new ESMA rate, which is a 5% margin. So from that we can calculate what margin we require in our fund in order to trade. So we just simply multiply 7,500 by the £5, which gives us 37,500. Multiply that by 5%, and that gives us a margin of 1,875. So in order to trade the FTSE 100 at 7,500 to buy the market at £5 per point, we would need to have a margin in our fund of £1,875. So in summary, risk management is an absolute imperative to your survival in trading. If you don't manage the risk properly, you're not going to manage your money properly, and your account is going to suffer. Management is fundamental to the money management. As I've said, it is complex by nature, but in simple terms, you never risk money, cannot afford.